Of all the dimensions of the market, the one that commands the most attention is price. Traders and investors are conditioned to think vertically. Their world is defined by charts that measure gains and losses in dollars and cents, and their every action is driven by the fundamental question of how high or how low. This singular focus on price, however, is a profound and often costly limitation. It is like trying to understand the ocean by measuring only the height of the waves, while remaining completely ignorant of the great, powerful tides that govern their every move. William Delbert Gann, through a lifetime of scientific investigation, discovered the secret of these tides. He proved that the true master key to forecasting the market was not found in the chaotic fluctuations of price, but in the unerring mathematical rhythm of time. He learned that a market's destiny was written not in dollars, but on a calendar. Among the many cycles he mastered, one stands out for its practical and powerful application in timing the most profitable swings of the market, the 90-day cycle. This is not an arbitrary number, but a fundamental recurring rhythm of the market, a natural division of the year that he used with uncanny accuracy to anticipate and profit from intermediate turns. It is the perfect bridge between the confusing noise of daily fluctuations and the slow, majestic pace of the primary trend. And it is a cornerstone of his forecasting method. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To truly grasp the power of the 90-day cycle, one must first understand the foundational philosophy upon which all of William Delbert Gann's work was built. He did not view the market as a random walk, a chaotic series of unpredictable events. He viewed it as a perfect, orderly mechanism governed by immutable natural laws. His entire methodology was rooted in a single unwavering conviction, a principle he drew directly from the Bible and applied with scientific rigor. The thing that hath been, it is that which shall be, and that which is done is that which shall be done, and there is no new thing under the sun. For him, this was not a piece of abstract wisdom, it was the ultimate market law. It meant that the future is but a repetition of the past. He understood that while the names of the stocks, the technologies, and the political headlines may change, the force that drives the market is eternally constant: human nature. The emotions of greed and fear, of hope and despair, are the same today as they were 100 years ago. These unchanging human emotions, when expressed by the masses in the marketplace, create distinct, repeatable, and therefore predictable patterns and cycles. This belief in historical repetition was the engine of his legendary work ethic. He asserted that no man could expect to make a success in speculation without first engaging in a deep and thorough study of the past. He wrote, "The more you study past records, the surer you are to be able to detect the trend of the future." His office was not that of a typical Wall Street speculator. It was a laboratory of a market scientist. He compiled vast libraries of data, creating by hand meticulous charts of stocks and commodities that stretched back for decades, in some cases over a century. He was not merely recording history, he was dissecting it, searching for the hidden mathematical order within. He measured the exact number of days, weeks, and months that separated major tops and bottoms. He analyzed the duration of bull and bear campaigns, the length of their corrective reactions, and the time a stock spent in its zones of accumulation and distribution. It was through this exhaustive empirical research that he made his foundational discovery: that market movements are not random but are governed by what he termed the law of vibration. He believed that every stock, every commodity, and the market as a whole possessed its own unique vibratory rate, its own internal clock. This rate, once discovered through the study of its past, could be used to project its future path with mathematical certainty. The 90-day cycle is one of the most important and most consistent of these vibrations. This philosophy led William Delbert Gann to a revolutionary and profound conclusion that stands in direct opposition to most conventional market analysis. Time is the most important factor in forecasting. He declared that time could and often did overbalance price. This meant that once a major pre-calculated time cycle had run its course, the force of time alone was sufficient to reverse the trend, often regardless of the prevailing news or the apparent strength or weakness of the price action. He wrote, "My experience has taught me that nothing can stop the trend as long as the time cycle shows uptrend. Nothing can stop its decline as long as the time cycle shows down." He knew that a market could become overbalanced in time, meaning its trend had simply run out of its allotted duration. At that point, the accumulated energy of the trend is exhausted, and the market is ripe for a reversal. This explains why markets so often seem to defy logic, going up on bad news or down on good news. If a bear market's time cycle is complete, no amount of negative economic data can force it lower. The internal force of the expiring time cycle is more powerful than any external news event. It is this unwavering belief in the supremacy of time that allowed William Delbert Gann to make his legendary annual forecasts, predicting major turning points months and even years in advance. He was not forecasting the news. He was forecasting the culmination of the market's internal temporal rhythm. To apply this knowledge profitably, we must first define the specific type of market move that the 90-day cycle is best suited to time, the intermediate turn. A market does not move in a straight line. A primary bull market, which may last for several years, is not a single uninterrupted advance. It is composed of a series of distinct waves or sections. There are powerful advances, which are then punctuated by significant corrective declines before the main trend resumes. Similarly, a primary bear market is a series of sharp declines interrupted by significant rallies. These major corrections within a bull market and major rallies within a bear market are the intermediate turns. They typically last from several weeks to several months, representing the most substantial swings within the larger primary trend. William Delbert Gann taught that while the greatest fortunes are made by capturing the entire primary trend, the most consistent and substantial profits for an active trader are made by timing these powerful intermediate swings. Trying to trade the minor daily fluctuations is a losing game of scalping that enriches only the brokers. Holding through the entire primary trend, on the other hand, requires immense capital and the psychological fortitude to withstand deep, unnerving corrections that can last for months. The intermediate swing, therefore, is the professional's sweet spot. It offers moves large enough to generate significant profits, often 10 to 40 points on an active stock, while being frequent enough to provide several high-quality opportunities each year. The key to capturing these profits, however, is timing. One must be able to anticipate when a healthy bull market is due for its major corrective decline, providing a low-risk opportunity to take profits and stand aside. And one must know when that correction is likely to end, providing a safe, high-probability entry point to rejoin the primary trend. This is precisely the problem that the 90-day cycle is designed to solve. It is a tool not for predicting the daily noise, nor for forecasting the end of a multi-year bull market, but for timing the great profitable intermediate turns that lie in between. Having established that time is the supreme factor in the methodology of William Delbert Gann, and that the intermediate turn is the professional trader's most profitable target, we now move from the philosophical to the mechanical. A principle is of little value without a practical method for its application. William Delbert Gann did not operate on vague notions of market rhythm. He operated on a precise, mathematical, and historically verified calendar of cycles. At the heart of his system for timing intermediate turns lies the powerful and consistently recurring 90-day cycle. This is not an arbitrary number. To understand its significance, one must look at the market through his unique geometric lens. He viewed the 365 days of the calendar year not just as a linear progression, but as a 360-degree circle. In this framework, the 90-day period represents a perfect 90-degree angle, a squaring of a quarter circle of the year. It is a point of natural geometric balance and therefore a point of high probability for a change in the market's trend. This 90-day cycle forms the cornerstone, but its power is magnified when understood in relation to its natural harmonics and multiples. Just as a musical note has its octaves, the 90-day cycle has its divisions and extensions. The first important harmonic is its halfway point, approximately 45 days or 1/8 of the year. This period often marks the culmination of shorter secondary swings within a larger intermediate move. The multiples are even more powerful. Two 90-day cycles create a 180-day period, or half a year. This is a major cycle that frequently marks the end of a primary swing from a major top or bottom. Three 90-day cycles form a 270-day period, or 3/4 of a year, another critical juncture for a major change in trend. And finally, four 90-day cycles complete the full 360-day to 365-day cycle, the anniversary year, which is one of the most powerful long-term cycles of all. By understanding this family of cycles, the trader is equipped with a complete temporal map, allowing him to anticipate turns of varying degrees from the minor reaction to the great primary reversal. This concept is directly tied to the natural rhythm of the year itself, a principle William Delbert Gann often referenced. He wrote, "The 4 seasons of the year teach us that there is a reaping time and a sowing time, and that we cannot reverse this order of nature's laws. The 90-day cycle is the market's own reflection of this seasonal 4-part division of the year, with the quarterly turns often aligning with the equinoxes and solstices, reinforcing their power. The ultimate proof of any market theory is not in its elegance, but in its practical application to the historical record. William Delbert Gann was a scientist, and his laboratory was the stock tape. His time periods for important swings table, a meticulously compiled record of market movements, provides the undeniable evidence for the power of the 90-day cycle. Let us dissect his own data. After the great bull market peak on March 10, 1937, the market entered its first major corrective decline. That decline culminated in the first significant intermediate bottom on June 14, 1937. The exact time elapsed between that high and low was 96 days. The market had completed its natural quarterly correction almost to the day, providing a perfect time-based signal to cover short positions and anticipate the secondary rally that followed. Consider another major turn, the end of the first leg of the 1933 bull market. After a sharp advance, the market made a major intermediate high on July 18, 1933. A severe decline followed, culminating in a final low on October 21, 1933. The duration of this entire corrective wave, from top to bottom, was 95 days. Again, the 90-day cycle had marked the duration of the intermediate turn with stunning precision. We can see this rhythm appear again and again in his records. The rally from the low of December 15, 1913 to the high of March 20, 1914 lasted 95 days. The major decline from the bull market peak of October 2, 1909 to the panic low of July 26, 1910 was 297 days, just over 3 90-day cycles. The records are replete with such examples. The advance from the low of May 14, 1924 to the intermediate high of August 20, 1924 lasted 98 days. The rally from the low of December 21, 1920 to the intermediate top of May 5, 1921 lasted 135 days, or approximately 90 days plus its 45-day harmonic. The decline from the high of September 13, 1939 to the low of January 15, 1940 took 124 days, another clear example of the 90-day cycle plus its 1/3 harmonic of 30 days. The power of the multiples of this cycle is equally evident. Let us return to the great turning point of 1932 bottom. After the primary rally from the July 8th low to the September 8th high, a major secondary decline began. This decline, which represented the great shakeout before the true bull market of 1933 began, made its final low on February 27, 1933. The total duration of this major corrective wave was 172 days. This is just 8 days short of 180 days, or 2 perfect 90-day cycles. This demonstrates the power of the half-year cycle in defining the duration of a major secondary move. The evidence is overwhelming. The 90-day cycle and its harmonics are not a matter of coincidence. They are a fundamental, recurring rhythm embedded in the market's structure, a temporal law that repeats with the certainty of the changing seasons. To apply these strategic rules with a master's precision, you must learn to grasp the dynamics behind every price movement. William Delbert Gann's Truth of the Stock Tape is the foundational guide for this skill. It's not a book of theory. It's a practical course that teaches the reader to understand the real-time contest between buyers and sellers, recognize the critical phases of accumulation and distribution, and assess a trend's true strength. This edition is a faithful reproduction of the 1923 original. The historical charts from that 100-year-old publication are included. While many are difficult to read, their inclusion was deemed important for historical context. The true, timeless value, however, lies in Gann's text. For any serious student ready to understand the market's real intent, this book is an essential resource. Get your copy via the link in this video's description. To possess the knowledge of the market's internal clock is to have a profound strategic advantage. The ability to anticipate with a high degree of certainty when a major intermediate turn is due elevates the trader from a state of constant reaction to one of professional anticipation. Yet, as with all the methods of William Delbert Gann, no single indicator, not even one as powerful as the 90-day cycle, was ever used in isolation. He was a master of integration, a scientist who built his case piece by piece, demanding a confluence of evidence before he would risk his capital. The time cycle told him when to look, but it was the alignment of time with price and the final confirmation from his charts that told him when to act. This is the final and most important part of the strategy, transforming the knowledge of cycles into a complete, actionable, and professional trading plan. The first and most critical layer of integration is the combination of time with price. A time cycle ending in the middle of a chaotic, trendless market is a signal of minor importance. But a time cycle that culminates precisely at a major pre-calculated price level is a signal of the highest order. It is a moment of perfect market harmony, a point where the temporal and spatial dimensions of the market align to forecast a reversal. William Delbert Gann taught that the percentages of extreme high and low levels indicate future resistance levels. Of all these, the most important was the 50% level. He considered this halfway point between any major high and low, or a 50% decline from an all-time high, to be the market's natural center of gravity, a point of powerful equilibrium. A high probability setup occurs when a major time cycle, like the 90-day cycle, brings the price directly to one of these major percentage points. Let us construct a practical example of this powerful confluence. Imagine a stock has been in a primary bull market. It makes a major high at $200 and then begins its first major corrective decline. A trader following the methods of William Delbert Gann would immediately begin his calculations. First, he marks the date of the high and projects forward 90 days on his calendar. This becomes his primary time window for a potential bottom. Next, he calculates the major price support levels. The most important of these is the 50% retracement of the last major bull swing, let's say from a low of $100 to the high of $200. The 50% level is therefore $150. Now, he waits patiently. The stock declines for weeks. As the 90-day time window approaches, the price falls to $150. This is the moment of alignment. The market has fulfilled its contract in both time and price. It has completed a 90-day decline at the most powerful support level on the map. This is not a signal to blindly buy. but it is the ultimate alert to watch the market with the focus of a hawk, for a major turn is imminent. This brings us to the final and most crucial step, the confirmation from the charts. The alignment of time and price provides the alert that a turn is probable. The mechanical reversal on his swing charts provides the actual trigger for the trade. William Delbert Gann did not act on his forecasts alone. He waited for the tape to confirm his analysis. His primary tools for this confirmation were the 3-day swing chart for the immediate trend and the 9-point swing chart for the more significant intermediate trend. Continuing our example, the stock has hit the $150 support level at the 90-day mark. The trader now turns to his 3-day swing chart. The trend on this chart is still definitively down. He does nothing. He waits. The stock may bounce for a day or two, but this is not enough. Then it puts in 3 consecutive days with higher highs and higher lows, and in doing so it crosses the top of the last minor swing on the 3-day chart. This is his first mechanical signal. It is the market's own testimony that the immediate downward pressure has ceased and that the buyers have retaken control at this critical time and price juncture. This is the high probability entry signal, with a protective stop loss placed just below the $150 support level. For a more conservative confirmation, or for a signal to add to an existing position, he would then watch his 9-point swing chart. A reversal on this chart, which filters out all minor moves of less than 9 full points, is a far more significant event. If the rally from the $150 low continues with enough force to cause the 9-point swing chart to reverse its trend to UP, it is a powerful confirmation that not just a minor bounce, but a new, sustainable intermediate uptrend is underway. This is the complete 3-dimensional trading strategy of William Delbert Gann. The time cycle provides the window of opportunity. The price level provides the location of the battle, and the chart reversal provides the final, unambiguous signal to act. You can apply this powerful technique to your own trading by following a simple mechanical process. First, identify the last major top or bottom on the chart of the market or stock you are following. Mark this date on your calendar. Second, project forward from that date using the key Gann cycles. Mark 45 to 49 days, 85 to 92 days, the 90-day cycle, 175 to 185 days, the 180-day cycle, and 265 to 275 days, the 275-day cycle, 270-day cycle on your future calendar. These dates are your high probability time windows where a turn is most likely. Third, as these dates approach, calculate the major percentage support or resistance levels, especially the 50% level. Finally, as the market enters the time window and approaches the price level, watch your swing charts with intense focus. Do not act until you receive a definite mechanical reversal signal. This process transforms trading from a reactive, emotional game into a proactive, scientific strategy of anticipation and confirmation. In conclusion, the 90-day cycle is far more than an interesting historical observation. It is a cornerstone of the scientific methodology that William Delbert Gann used to time the market's most profitable intermediate moves. It is not a magic number, but a practical and powerful tool that, when integrated with his principles of price and chart analysis, creates a complete and formidable trading strategy. The cycle provides the map of the future, alerting the trader to when and where the great battles of the market will be fought. It allows him to move beyond the daily noise and to focus his attention and his capital on the moments of highest probability. By learning to measure these temporal rhythms and by waiting patiently for the market's own confirmation, the trader can learn to anticipate, rather than simply react to, the market's turns. This is the essence of the Gann method, a scientific approach that replaces guesswork with calculation, fear with confidence, and gambling with a profitable profession.